Our speaker today is Adele Kilbane. Welcome, Adele. She is our Senior Manager at Specialist Accounting Solutions. Adele is an ACCA qualified accountant with a range of experience across a variety of sectors. We also have Sean Hackerman, our director, on the call, who will be part of the Q&A session at the end. And so if everyone's ready, I will now hand over to Adele. Thanks very much, Adele.
Thanks, Maria. I thought I'd start with a bit of background about our company, Specialist Accounting Solutions. So we're an accountancy practice based in Reading, although we do have clients all over the country, and we specialise in advisory and financial outsourcing. So on the advisory side, we can assist with something like a cash flow forecast, or something more complex like an integrated financial model. We can assist with business valuations if your company is raising any capital, or if you're going through any acquisitions or disposals, we can also assist and support with that. Then on the financial outsourcing side, so we could be your outsourced finance function. We could be your virtual head of finance or virtual FD. We can assist with the bookkeeping, or if you have a bookkeeper in-house, we can support them and produce some useful management information from the accounts. And then on the compliance side, we can assist with statutory accounts, tax, VAT and payroll. And we do have a variety of clients from all different industries, including hospitality, pharmaceutical, professional services and online retail. Getting into the webinar, why use a cash flow forecast? So cash is king, I'm sure we've all heard that before, but cash always has been and remains a critical tool when running a business. It's essential to have enough cash to continue to trade and pay suppliers and staff. A cash flow forecast is a tool to help predict the likely cash position of your business, and it can help you plan ahead and provide visibility, especially in challenging times. So the cash flow will make you aware of any upcoming cash challenges opposed to being caught off guard. If you are forecasting a cash crunch, then you can plan and devise steps early on to ideally avert or delay the liquidity crisis that your business might face. Or alternatively, if you have surplus cash in your business and you're looking to expand, the cash flow can help plan the timings of that expenditure. So as part of this webinar, we'll be sharing our own cash flow template, which I'll be sending out to all of the participants after the webinar. There are many templates available out there. So although we will be referencing to our own template in the webinar, they should be comprised of pretty much the same key components. So on the right-hand side, you can see this cash flow template here. And this has got 3 sections. So we have the cash inflows, which is this top box here. Then the second larger one here is the cash outflows. And then at the bottom, we have got the opening and closing balances. And we will discuss each part of this cash flow in more detail during the webinar. Then on the left-hand side here, we have a graph which shows the closing cash position for each of those weeks. And again, this is part of our cash flow template. So as part of the template, there are 2 tabs. The first one is this graph, and then the second one is this one here where you would input your data. The template is mostly aimed at SMEs and small businesses, but it can be tailored to your company. And to help you with that process, this webinar will offer some suggestions of ways to categorise your cash inflows and outflows. A point to note is that most SMEs just have one main trading bank account. However, if you do have multiple bank accounts, you could either include the cash movements and cash balances of all of your accounts in the single spreadsheet. So you have one cash flow template with all of your movements in there, or you could prepare a cash flow for each of your separate bank accounts. We would recommend the former. I think it's a lot easier to see the overall position of your business when you have the consolidated cash position, but you have 2 options there. Looking at general principles of a cash flow forecast. So we start off with the opening balance. So this will be from your bank statement. Then we'll have the cash inflows and the cash outflows, which result in the net cash movement. And these components are used to calculate the closing balance for the period that we are forecasting. So in terms of timeframes, A weekly forecast between 8 to 16 weeks is recommended, as predicting cash on a granular level past this is quite a challenge. Obviously, it depends on the nature of your business and how fixed your cash inflows and outflows are, but a lot can change in the space of 4 months, especially for small businesses. Remember to always use the gross figures in your cash flow forecast for both the cash inflows and outflows. So this means that the figure will include the VAT. So obviously gross figures include the VAT, net is without the VAT. So for example, you may invoice a customer £100 for a service or some goods, plus the VAT. So the total invoice would be £120, obviously the VAT at 20%. So that invoice, although you will be recognising £100 worth of sales, you will receive £120 from that customer. So that will be the figure that you would use in your cash flow forecast. Look at the past to predict the future. So we recommend reviewing historical data, such as previous management accounts and bank statements. So you have a very good understanding of your cash inflows and outflows that you would need to include. And this review process will help you build a more accurate forecast. So looking first at the cash inflow, so this again is a screenshot from our template. Start with that first box on the other slide that I showed you. So cash inflows will be any monies in from any clients or customers. And in this example, we've broken down the cash receipts by client. So there are a number of invoices that are due from customers 1 to 10 here. And we're trying to predict when these will be paid, not when they are billed. So when reviewing the historical data, you can gain an understanding if the initial assumptions you wanted to apply in the cash flow were realistic. So for example, you may have assumed that all of your clients would pay the week the invoice is due, but it turns out that's not the case and your customer pays a lot later. So for example, you might have 30-day payment terms with a certain customer. However, when you reviewed the historical data, you could see that they normally pay in 60 days. And that will be the assumption that you will need to apply in your cash flow, as that is the most likely scenario to happen, as this cash flow should reflect a real life scenario and it should not be too over optimistic. We generally would say to be more prudent than over optimistic, especially with cash inflows. If you're unsure that that amount is going to be coming in from a customer, it's better not to put it in than put it in and overinflate your closing cash balance. Next, looking at the cash outflows. So again, we've got this screenshot from our template. We find it really helps our clients to categorise the types of expenditure in their business. So you can see on this spreadsheet, we've got the major categories of expenditure that most businesses incur, and you can add or amend these categories as you see fit. So at the top here, we've got our payments to suppliers. Then we've got our staff costs. So this will be salaries, pension, PAYE and NICs. Then we have other taxes, so VAT and corporation tax. The next category is rent and rates. And then we've got other costs. So this could be any odd subscriptions that you have, any direct debit, anything like that can go into that category. And then at the bottom there, we've got our loan repayments. Remember, it is a cash flow forecast. So the week that you enter the figure into the cash outflow section of the template is when you'll actually make the payment. So it's not the date of the invoice. For example, you may have one payment run a month. Say if your payment run is on the 30th of the month, that needs to be on the week commencing the week of the 30th. That's where you need to pop in those cash outflows. Even if some of those invoices have a differing invoice date or due date, whether that's before or after the 30th, if that's when you are most likely going to be paying that invoice, that's the column that you need to input it in. It's really important to include any payments to HMRC, including any payroll taxes, VAT and corporation tax. And then another item that is easily overlooked are the pension payments, so ensure those are also included. So looking now at those totals that were at the bottom of the template. So we start here with our opening cash balance. So this cell here, that's in yellow, that 10,000, that will be from your bank statement. So at the start of that period in week 1, you will enter your opening cash balance. Then we have the net cash movement. So again, that will be all of the cash inflows and outflows. And we can see in this week there's a net cash outflow of that 29,700. And then that will give us our cash balance, which is obviously the opening balance, plus any cash movements will then give us our closing cash balance. So we can see that closing cash balance for that week, that first week, is 19,700 in negative or overdrawn in this case. And this closing cash balance then carries forward to be the opening balance of the following week. So we can see again that 19,700 withdrawn is then the opening cash balance for the second week, and that continues for each of those weeks. Graphs and other visuals are helpful to see the movements in cash in a snapshot and to highlight pressure points in the cash flow. So we can see here we've got 4 weeks where the cash is in negative or overdrawn. And we can see especially this one here in week 5, this is followed by a big inflow of cash. See that week 6 cash closing cash balance goes right up. So just looking at this higher level, we could say possibly some of the payments that went out in week 5 could be delayed until week 6 so that we aren't in negative cash or overdrawn for that week 5. And just generally, if you do have some negative cash points, we would suggest reviewing and delaying payments, chasing up debtors, or even possibly reviewing your overdraft facility or seeking funding. But obviously that does depend on your business, and this is just a high-level snapshot. The checks to run, make sure to check all of the formulas. It's quite easy to add rows in Excel and then forget to check the sum at the bottom that includes the additional rows. So always check the formulas and sums at the bottom and on the right-hand side. Ask yourself, is your forecast closing cash balance realistic? If it looks too good to be true, it probably is, and you need to revisit your assumptions because you may have overstated your cash inflows or forgotten to include some of the costs. Prepare what accountants call a proof in total. So this means that you need to check whether the adding sum of all of your cash inflows and cash outflows to your opening cash balance results in the same closing cash balance that you are forecasting. So essentially, it's just an extra check that everything is included. We can see here, this again is from our template. We have this little check at the bottom. So we have the opening cash balance there. We add any cash inflows, take away any of those cash outflows, and then that leaves us with a closing balance. And we're checking that balance back to those totals that were at the bottom of the template to make sure that everything is included. After the period has passed, compare the cash flow to the actuals in the bank statement to see if your forecast was accurate. So this is a really good check. So after the week's passed, compare your actuals in your bank statement to what you had in your cash flow forecast. So have a check if the cash inflows that you're predicting to come in, did those come in? And the cash outflows, did you include everything in there? And that way then you can amend the cash flow going forward. Say if you missed some payments in there, possibly some direct debits, you can add those in. Or if you were overstating or understating your sales, you can then adjust your assumptions going forward. As generally, the outcome of your cash flow is only as good as the data inputted into the template. So using the cash flow to make decisions. So we do say there's quite a lot here, but better management information leads to better business decisions. So having a robust and realistic cash flow forecast can really make the difference when you have to make key decisions in your business. For example, recruiting a new member of staff, you might be buying a new piece of kit, or expanding into new areas which require a lot of expenditure. Whatever your challenge is, if you invest the time into preparing and updating your cash flow regularly, it will help you make better decisions. If you're at an inflection point and want to build a picture of what happens if, then you can run different scenarios and use different assumptions in the cash flow to see the position of your business in these different scenarios. Again, the cash flow will help your decision process and coming to a robust conclusion. If you think you'll be facing some cash flow challenges, then we would always recommend a short-term cash flow forecast. You might wrongly assume that you need to raise a certain level of funding, but without spending the time on a forecast, how will you know if the figure you're working with is about right? having a good handle on cash and understanding if you could potentially pay some suppliers early to get some discounts can help build a more solid business relationship. So, for example, some suppliers do offer some early payment discounts, and having the cash flow forecast can help you do this and understand the risks if there are any. That's everything from me on the webinar. I'll pass back over to Maria, who will run through some of the questions, but I will leave this slide on the screen in case any of you would like any further information and would like to get in touch.
Great, thanks very much, Adele. That's really helpful. Let me just make sure I've unmuted Mr. Hackerman here. Can you say something, Sean, just to do a quick check that you're... Oh, great. So if you do have any questions, feel free to put them in the Q&A box, which we've got on this platform. We did have some questions that were sent through in advance. One of them is, so if you're starting a new business and don't have historic numbers, can you still do a cash flow forecast, or if not, when do you start?
So I would suggest starting to use a cash flow straight away, especially if you're starting a new business and your funds are limited, which is quite common in a new business. So I would say populate any known costs that you have. So could be salaries, rent, or any loan repayments, if that's applicable. But as there will most likely be no sales in there, it's important to start the cash flow forecasting early to understand how long your cash will last.
Great, cool, thank you. We did have another question. How often do you recommend the cash flow is updated?
So I think when you're first starting out with the cash flow forecast, I'd recommend reviewing quite regularly. So I would say every 1 to 2 weeks to ensure that your assumptions are correct. Then once you have got these assumptions confirmed or more robust, I would still suggest updating quite regularly. So maybe every 3 to 4 weeks, depending on the cash position of your business. Like if you're in more a cash crunch, then update the forecast more regularly so that you're watching this cash on a granular level until you're then out of the critical cash position. But even if you're not in a critical position, I think it is useful to update every 3 to 4 weeks or monthly.
Great. There was one question that said, what should I do if I will be hiring a new member of staff?
So your starting point would be the gross salary of that member of staff. And say if they started halfway through the month, then you'd only include half of that gross salary. Then you would need to add Class 1 employers' national insurance on top of that, which is that 13.8%. You then start paying the employer's national insurance after a particular threshold, which is known as the secondary threshold. And just generally for auto enrolment, you'll need to add the 3% of their gross salaries as estimated pension contributions.
Cool. We've got, there was one more, we haven't had any from anybody listening, but please do post any if you have any. The other question was, what should I do if I've not yet received a supplier invoice for the later weeks shown in the cash flow forecast?
So I think it's best to look back at the historic supplier invoices, if there are any, and possibly take an average over the last 3 months or use the most recent figure. I think it depends what that supplier is supplying, if it is a regular cost or not, but just use whatever figure you feel is the most likely amount that you'll need to pay and enter that into the forecast.
Brilliant, cool. Sean, did you have anything you wanted to add?
No, I think Adele's really captured everything very, very well. So yeah, I mean, going back to the first question, I think, if you want to calculate this cash runway that you have as a new business, I think it would be good practice to start doing the cash flow, as Adele said, right from the beginning, because your cash runway could be quite critical in the first few months, could be quite important. You might start off with a certain level of funds, and if you're not sure how long it will last, the cash flow forecast can really give you a much better feel for how and when the money's going to go out and on what you're going to spend it on. Obviously, you'll have a picture in your head how that will pan out, but if the Excel spreadsheet is set up correctly and the assumptions are robust, you'll have a level of comfort around it. If anything, it's kind of, we found that historically, working with clients and even current clients at the moment, when it comes to cash flow forecasting. It gives you comfort around making decisions and knowing where you're at. That's really what it's all about. It doesn't necessarily have to be a business critical position that you're in. In other words, will you run out of cash or not run out of cash? But it does help make decisions that are important to you and your business, which, if you're spending a lot of money, I think it is really key. So I think having a cash flow forecast to help you make decisions, whether or not you're well funded or not, I think is always really important.
Cool. Thank you. We've got a question from Lee. He said, would you recommend Xero Analytics Plus, as we have 15 pharmacies, all with their own bank accounts, but all linked to one Xero account? We have 3 staff running these accounts, so would this be better to save times than having to keep updating Excel sheets?
Do you want to cover this one, Sean?
Yeah, we are aware of Xero Analytics. We have other software that we use to pull data out of Xero, so we don't use it on a regular basis, but we know the basic analytics package. So if that information feeds into something that you can consolidate quite quickly, then that might be an idea. But we don't use it. We use another piece of software to obtain that data. But I think in general, any kind of information that helps you get to grips with the data on a regular basis, and that where you know there's less automation involved, and you can get hold of the information as quickly as possible and as easy as possible. In other words, you're very efficient at that. If whether it's Analytics Plus or something in QuickBooks or whatever other package you run, I think that should be taken advantage of. And you can always see whether it's worthwhile using. Use it on a trial basis, this Analytics Plus package, see whether it works for you, and if it does, it does, and if it doesn't, then you ditch it and try and use something else. But I think anything that you can get hold of information quite quickly and efficiently, that's definitely the case.
Great. Okay. Thank you. Are there any other questions? Hang on a second. Oh yeah, Lee says thanks for answering. Fab.
You're welcome. You're welcome.
Great. Thank you. Yeah, so if there are no further questions, let me just see. I don't think there are. We will call this meeting to a close. Thank you so much, everybody, for attending. It's lovely to see a good body of turnout of people attending. Thanks to Adele for her presentation, and thanks to Sean. Thank you, everyone. Have a lovely afternoon.